Welcome back to the What's Your More podcast. I'm your host, Quinton Harris. You're tuned into episode 141. Thanks for joining us today. We're going to talk about PCE. We're going to talk about what just came out on Thursday. Today's Monday the 4th. It was a big headline week for that. What does it mean for the Federal Reserve and their meeting coming up on the 19th and the 20th? We're going to give our forecast of what we think they're going to do. And then finally, we're going to talk data leaks and cyber attacks in the mortgage industry. Yeah, scary but real. And why does it matter? So let's jump right into it. First thing I want to talk about is personal consumption expenditures, the PCE model. Now, for the last couple of weeks, it's been in the headlines about the CPI inflation and the PPI and, now the PCE. And we're all inflation experts by this point, right? That's all we've heard about, especially when it comes to the Federal Reserve. But let's first start with some of the basics. Federal Reserve, what's their target interest rate for inflation? It's 2%. It's been 2%. It seems like forever now. That's what they keep talking about. That's their target mark. Why is it their target mark? Because I think behind closed doors, someone whispered 2% and it got out to the general public, and literally that's how we've got 2%. I'm not kidding by that. It's never etched in stone. This is just something that was mentioned behind closed doors several years ago, almost a decade ago, 2 decades ago, and this has been the target range ever since then. I'm sure there's other philosophies to it, but literally that is where this is coming from. So the 2% target rate inflation. And the one index that they look at is the PCE, they being the Federal Reserve. They've talked about this over and over again. Yeah, they have an eye on the CPI over there. They definitely don't pay attention to the producer price index. It's, as our friends at MBS High always say, it's the Rodney Dangerfield of inflationary index. It gets no respect. So when we take a look over at what they are looking at, which is the PCE, they always look at the core reading. Remember, there's two readings on the PCE model. There's going to be the overall headline and there's going to be the core. And then there's going to be an expected headline and an expected core reading that come in. In this particular case, everything came in at expectations or less. Headline dropped just a little bit, and the core came in as expected, but hotter than the previous reading. So what does all that really mean? Well, this is what it means to you and I. That means that the overall index came down, stayed down about 2.9 as a headline, and that the core reading went up slightly, but still under 3%. Now, if you were to take those months' readings and amortize them out over 12 months, you'd have a hotter than 2% inflation. You'd be in the threes, maybe in the fours in some cases. But the good news is there's 11 prior readings for the prior 12 months, and that all makes up the overall index. Now, one of the things the Federal Reserve Chairman Jerome Powell has said at his podium is that they're going to continue to look at a 3-month reading, meaning they're going to take the last 3 months of the PCE, the 6-month reading, which they take the last 6 months, and then the last 8 months, and they're going to come up with extrapolated readings over that time frame. Well, if you do all of that, guess what? We're to 2-handle on PCE. Now, 2-handle being 2.4 to 2.9. But why is that relevant? Why is that important? Well, because it has that magical 2 number on front of the index reading there, on front of the inflationary reading. And that's important because that's what the Federal Reserve is looking at and monitoring, which then bodes the question, are they continuing to be too restrictive? And is it time to take their foot off of the gas pedal and start lowering the federal funds rate? That's the million-dollar question, right? We got a meeting coming up on the 19th and the 20th. Everyone is asking, what are they going to do? Most pundits are saying there's zero chance of a Federal Reserve rate reduction here at the March meeting. I said 2 weeks ago, I think that they have an outside chance that they're going to lower it, and I stood by that. Right now, I would say it's about 4th and goal from the 30, and, we've got no seconds left on the clock, and are they going to do it? That's kind of if you're a football fan, you know that there's odds are not in your favor to win that, and that's probably what's going to happen with the Federal Reserve, but there's still an outside chance, which then bodes the next question, when are they going to lower it? And right now, the outside community and economists are screaming that next rate cut is coming in June, and with a 70% chance of that happening. I do not believe it will happen in June. I do believe it will happen before June. There's quite a few reasons why I believe that. I'll kind of go into it with the following one here, is that we are up against immense pressure. We as a United States community are up against immense pressure with the national deficit. It's something I've talked about on many different episodes, and now starting to get a little bit of attention, not because I'm talking about it, but because the facts are starting to stack up. So what happened recently in the last couple of days? Well, over the last month, I believe we clipped $34 trillion, but the interest payment that the United States government is paying on that debt right now is more than the amount of money we spend on an annualized Department of Defense budget. Let that set in for a minute. If that doesn't bother you at any component, it should, right? I'm not saying there's something wrong with it. I'm just saying let that set in, because when I read that and I saw that, it didn't shock me because we've been talking about it for so long, but it did kind of tick me off a little bit, because I do think the Department of Defense is one of the more important budgets that we need to have and allocate funds for. And for us to pay more interest than we do for that budget doesn't excite me. It actually kind of upsets me a little bit. And not only that, the interest is only going to continue to grow because we continue to operate at a deficit. Because when you look at the national budget, this is some of the areas I get more comments online than anything else. And it really shows me how passionate some people are about where we are and how some other people just really don't care. And then some just don't get it. And that's okay. That's kind of part of our education platform and what we're trying to do here. But the idea of a national deficit is every year the federal government sets a budget. Consider it like your household budget, except the only difference is they don't adhere to it. And when I say they, again, I don't care who's in office. This has been going on since the Clinton administration. So whether it's a Republican or Democrat, neither one of them have adhered to the budget. And one of the points that I made to some commentary, because everybody online likes to take a side, right? And it's either going to be Trump did this, Biden's done that, pick a side, you put your flag down and you stand by it and you get upset. But the reality is, all of the spending that's taken place, again, since the Clinton administration, it's 77% bipartisan, which means both parties are joining to spend this money. It's not just one. I think that's really important. It's bipartisan spending. So going back to the budget, a budget is set and they're not adhering to it. They're actually going over budget. And the reason that's happening is because we have threat of government lockdowns, shutdowns that happen, at least once a year. Sometimes it's twice a year. I think this year is going to be 3 times in 1 year that's happened over the course of the last 12 months. So that's how they're running out of money out of their budget. And so they have to vote to extend that and make that happen. And so every time they do that, they're going over budget. And that goes towards the deficit for that year. And then the total running deficit of that is the national deficit. And then they have to pay interest on that money because they're printing money, right? And they're selling that off as a form of a security that they're printing. And someone has to get paid for that, right? So there's debt holders of the United States debt. And it's made up of taxpayers, citizens, investors, other countries such as Japan and China, in that order in particular. So at some point, that can't keep going at that rate. And quite frankly, as long as we have as large of an interest payment that we have currently right now, you're always going to be operating at a deficit. And so that means the number is only going to get bigger and bigger. It's a compounding effect, and we've described what that does. So why is that important to the Federal Reserve? Well, the interest being paid on that, a lot of that interest, if not all of that interest, is determined by the federal funds rate, which they control. So I do think at some point there's the term of the Federal Reserve's kind of handcuffing themselves a little bit. I also think that plays a huge role in this decision making, even though it's not talked about a lot at the podium. The second thing is the job reports. At some point, the job reports, we got them on Thursday, are starting to show signs of not improving. They're not drastically bad, but they're actually deteriorating. And I think those job reports become even more important as we have conflicting information from the PCE and the CPI. And so what is that conflicting information? Well, let's take a look at shelter. Shelter makes up 45% of the CPI. And for the record, the CPI came in hotter than expected, right? Again, Federal Reserve doesn't pay much attention to that, but it is worth noting. Well, the CPI was the leading component, the shelter cost was the leading component of that. And so there's a couple things that make up shelter. One of them is the rent itself, like rent trends and rent rolls, and then the owner's equivalent of rent, and then lodging away from home. Speaking of shelter costs and lodging away from home, as I was walking out of my house this morning to come to work, I saw one of the most creepy headlines on the news, and it was about hidden cameras in Airbnbs, hotels, and locker rooms. Ugh, you probably know exactly what I'm getting at with this. But the reality was they took a family and they said, hey, here's a house, X amount of bedrooms, X amount of bathrooms, laundry room, etc. You get the picture. There is a camera in every room. So let us know which device, what wall, fixture you think it is, and we'll kind of meet up at the end here and discuss it. They didn't get a single one of them right. And I mean, there were cameras everywhere. Super scary and creepy. And I think that had this article come out or this headline come out maybe a month or two earlier, we probably would have had less lodging away from home. And that index that just came out and probably would have helped us a little bit with the CPI index. Now, we just did a last episode where we talked about the lodging away from home kind of came out of nowhere on that one. And it really, really kind of threw that off. But the other one was owner's equivalent of rent. Rents were coming down. Owner's equivalent of rent was going up. So what is owner's equivalent of rent? Well, we've talked about this before, but just a reminder, that's where they do a survey, and inside that survey, they make phone calls to homeowners like you and I. You own a home, they call you and say, hey, if you were to rent your home, or if someone was to rent your home today, what would you rent this for? Wow, what a dangerous question there. And the reason being is that I don't know accurately what I would rent my home for and if that's correct to the market trends, but I would give you a number. Well, surprise, surprise, the number that they got from the owner's equivalent of rent was actually much higher than what the current rent rolls are showing or the rent trends are showing. And this is the first time the disparity has been that great. They're not always in line, but they're not this far apart. And so I think that's worth noting. And I think that also the lodging away from home kind of also threw that off. So that makes up 45% of the CPI. Well, it only makes up 32% of the PCE, shelter does, right? And so the owner's equivalent of rent makes up 1/3 of the CPI, but makes up 1/6 of the PCE inside that shelter cost perspective. So I think that there's a big difference as to why one headline came in higher than the other. But getting back to why I think the Federal Reserve is actually going to lower that. So we've talked about the national deficit, we talked about the jobs report, and then finally I'm going to talk about the fact that I think that it's enough. They've already done what they needed to do. It's restrictive. They said that we are looking for a 2% target rate inflation. We're looking at a 3-month, a 6-month, and an 8-month window of the PCE, all which have a 2 handle in the core section. Everything is being achieved. And just sitting here and holding the pause button, I don't think is something that is productive and is something that's stimulating the economy necessarily. And an economy that is, you can tell me that it's healthy, but we've done many episodes why we can kind of contradict why it's not healthy on there. And so I think the gas is going to come off the pedal. If not this meeting, definitely the next meeting before the June meeting. So I think that's important. And I think there's signs pointing towards why that's going to happen. And then this one, I'm going to say, doesn't really add into their equation. But statistically speaking, in an election year, you do see rates start to drop earlier in the year as we get towards the November month. And I think that time is going to start. Now, the odds makers say it's June. I think it's coming before June. I actually thought it would be in this March meeting. Even though it hasn't happened, the odds do not look good. But I still think there's an outside chance on that, and definitely going into the next meeting. So let's jump into cyber attacks and data leaks. So, if you're a customer and you've done any type of lending at any capacity, whether it's a home or a car, credit card, you expect your data to be safe. I mean, I know I do. If I give someone my social security number, that's like one of the most scary moments that I have in my life, because I know what that means. It means I got all my data at that point. And then if I share my bank record information through a mortgage lending process, that definitely scares the heck out of me. And I definitely want to make sure it's secure. Now, I'm assuming that many lenders have two-factor authentication, if not all, but it baffles me how these major lenders are being hacked right now. And they're being hacked to the tune of thousands of data leaks and data breaches taking place, to where these hackers are getting social security numbers, access to their names, their email addresses, their phone numbers, their bank records, their bank account information. Like, this is stuff that's non-public private information and should be extremely hard to get to. You shouldn't have to apply for a loan and then pray and hope that information isn't stolen later on, and then use any ramification post it being stolen. I mean, these are major servicers this is happening to. So a servicer, for example, is someone that once you close a loan with your mortgage lender, your mortgage broker, your bank, that loan is usually what we call serviced and transferred over. A very common practice that happens, and it gets to a master servicer, or it gets to a rather large servicer. Once they have that file, or they have your loan, they get it in batches of other loans, they have all your data. Well, that data should be secured and stored, not leaked, right? Not taken. And that's exactly what's happened here. And that many of these servicers are being sued for millions of dollars for these data breach leaks. And I don't know that that's enough, quite honestly. I think there should be higher repercussions for that than just financial civil penalties, because sometimes you won't be able to financially recover from your identity being taken, used at many different angles. And I mean, what if your bank account is hacked? What if your account records are stolen? What if it's used for something else? I mean, there are times in which it takes years to recover from all of that data leaks, especially on the credit side of things. We've done a lot of credit episodes where we talk about the impact of accounts. Imagine a false account. Imagine an account being opened under your name, your identity, credit card being ran up, bill never being paid. I mean, there's all kinds of things that you have to endure after that. And do you think a creditor is going to believe, that wasn't me, someone else opened that up? Like, no, that takes time for all that stuff to kind of recover. And so it's kind of a slippery slope when you start to see this happen. Like, what's the impact? And vulnerability in a system is usually not an excuse, in my opinion. And speaking of other excuses on there, and I'm sticking to this because I'm not on a high horse here, but these are major things that are kind of just disturbing. So we're looking at major data brokers. So what's a data broker? A data broker is someone like Zillow, right? I'm going to pick on Zillow for a minute. They are one of the 11, and they're the only one that I'm going to pick on in this particular one because, quite frankly, I think that they deserve that. So anyhow, they're a data broker in this case, right? And Zillow, amongst others, basically were posting information about names and home addresses and phone numbers of protected classes. So what are protected classes? These are judges, law enforcement officers, prosecutors, and their families. Under Daniel's law, which I'll explain in a minute, those names should not be published, nor should that information. Well, why is that? Well, it doesn't take an Einstein to figure out that not everybody's always happy with the police or with the judge's decision or with the prosecutor or their family. And so that information is called a protected class. And so right now you could go Google, or you could even go to a tax record and look up, if I want to find where Charlie, my producer, lived, I could type in Charlie's name under the county in which he lives, and I can find out exactly where he lives if he's a homeowner. Now, if he's renting, that's a little more difficult. But if he owns a home, I can find that out, right? That's public information. When it comes to those classes I just described, it's not public, and it's not public for a reason. Because in 2020, an angry gunman went to a federal judge's house to go take matters in his own hands, and his son Daniel was there, and he shot and killed him. Thus, Daniel's Law is the name of this unfortunate situation that happened, because that is something that happens. And unfortunately, criminals do take things into their own hands. Angry family members of defendants that didn't go right take things in their own hands. And if you don't believe that, in this particular court case that was filed, they talked about where a leader of a criminal organization literally reportedly and found this information on one of these platforms I'm describing, and he had images of the home in which the investigating officer of his particular organization lived, as well as pictures of his children's bedroom inside of his house when they discovered what he was doing. That's crazy. Like, that should not be available for those very reasons. And so I will say this, shame on you, Zillow, as well as the other 10 people who I'm not going to name, but shame on you. You should not be publishing this information, and there's a reason for this. That should be protected. And if you think that I'm kind of like ticked about that, it's because I have family that's in law enforcement, and I understand exactly why that's done. And I understand that it's there to protect, not to actually make their lives more difficult. So I do get a little fired up about that one there. So, plus, I don't like Zillow. I think I said that more than once, so I'll continue to stand by that. But let's come off that a little bit and kind of finish up the episode here. So, obviously, we got the Federal Reserve on the 19th and the 20th. We'll be back for the Jerome Powell show to talk about that. Boy, wouldn't it be nice, though, if we get that quarter? Wouldn't it be awesome if we get even an eighth decline? The markets are just busting at the seams waiting for that, and they continue to price in all of these future wins, and they're not happening. Boy, would it be nice if we get one. What does that do for our buyers? What does that do for our sellers? What does that do for the real estate industry? And what does it do for the credit card market? It's a lot of wins because rates come down, and it improves a lot of the financial systems for the consumer. So I look forward to that. Guys, if you like what you're hearing, check us out on our YouTube channel at What's Your One More with the number 1. And then if you would, on any platform that you listen to your podcast, please give us a rating on there, 5-star plus, leave a comment. We'd love to hear from you, and love all the comments you're leaving. We're going to do an episode to answer a lot of those, a lot of good stuff you guys are leaving online. Till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into